Hello and welcome to the Credit Compass, your guide to navigating European credit markets. Each week we unpack key developments in credit, explore macroeconomic trends shaping the landscape, and dive into the strategies that matter most for investors across Europe and the UK. Whether you're a fixed income veteran or just finding your footing, our aim is to make the complex world of credit more transparent and actionable. This week, we're looking at the recent rise in oil prices and what that means for European markets, from inflationary pressures to growth implications, and how Europe's energy transition might be changing that dynamic. We'll also touch on the UK's latest spending review and check in on the evolving story of European banking consolidation. All right, let's get into it. The geopolitical situation has continued to deteriorate, with Israel and Iran now engaged in direct conflict. The human toll is, of course, tragic, but from a market's perspective, the concern lies in the region's outsized role in global oil supply. Nearly one-third of the world's oil comes from the Middle East, with Iran alone producing about 3 million barrels per day. Iran has now threatened to close the Strait of Hormuz, a critical route for global oil shipments, which would drive prices even higher. Since early May, Brent crude has risen from around $60 a barrel to about $74 as of the 17th of June. That brings prices back in line with their 2022 to 2024 average. For context, Brent traded between 55 and 60 pre-pandemic. West Texas Intermediate has been more volatile, but follows the same general trend. Added to this is the pricing of natural gas. The ICE Index Dutch TTF index has risen to 39 euros per megawatt hour, up from a low of around 32. However, it remains well below the highs of over 55 in February. So why does this matter? Oil and natural gas are foundational inputs for the global economy. Higher prices feed into both producer and consumer inflation. In the Eurozone's harmonized index of consumer prices, energy, including fuel and electricity, makes up about 8 to 10% of the basket. The European Central Bank uses a rule of thumb that a 10% rise in oil prices, in euro terms, adds around 1.5 percentage points to energy inflation and bumps overall CPI by 0.1 to 0.2 percentage points within 6 months. With oil up about 20% recently, that would imply an additional 0.2 to 0.4 points of inflation. But that's just the first wave. The second round effects tend to be more significant. Higher oil prices raise transport and production costs economy-wide, and firms often pass those on to consumers. Recent analysis suggests that these second-round effects added around 0.5 percentage points to inflation across advanced economies by late 2022. Producer price inflation, or PPI, typically reacts even faster and more violently to commodity shocks. In the 2021 to 2022 energy crunch, Eurozone PPI soared by over 30% year-on-year, dwarfing the rise in CPI. In Germany, PPI hit 32%, Italy 37%, and several smaller economies even exceeded 50%. These surges reflected exploding input costs, oil, gas, electricity, which weren't immediately passed on to consumers, thanks to either fixed contracts or price controls. So while energy CPI jumps quickly, we also tend to see broader price pressures emerge over time. But on the production side, the inflation was instantaneous. PPI is often the market's first responder, and we'll likely see that again in the coming months. Central banks, as a result, will be watching for those ripple effects closely, including any wage inflation feedback loops, which they have just been getting over. As a result, there is likely to be a more hawkish stance going forward. The impact varies by country. Europe's energy tax structures and consumption habits shape how oil prices flow through to inflation. For example, many European countries impose high fixed excise taxes on petrol and diesel. That means even a sharp jump in crude prices leads to a much smaller increase at the pump. So the percentage pass-through to CPI is relatively muted. This has helped countries like the UK, France, and Germany contain some of the inflationary impact. Some also use price controls to smooth volatility. Still, During the 2022 spike, inflation in Germany hit 8%, Italy topped 11%, and even France, with its nuclear base and energy subsidies, saw inflation hit 7%, the highest in decades. Smaller Central and Eastern European economies saw even sharper inflation, largely due to higher reliance on imported fossil fuels. Data from 2022 confirmed that inflation rose most in countries with high energy intensity and less reliance on services. As a result, you can understand that the European economy is relatively sensitive to the movement in oil and gas prices, given their recent impact on inflation and producer prices. Now, that brings us to something that's been quietly evolving. The relationship between oil and inflation is starting to weaken, even over the past 3 years since the most recent energy crisis. Europe's energy transition is playing a role here. The growth of renewables, rising energy efficiency, and adoption of electric vehicles are gradually reducing the economy's sensitivity to oil shocks. While high oil prices in 2021 to 2022 still triggered record inflation, Europe's more diversified energy mix prevented even worse outcomes. Countries that leaned more heavily on renewables or offered energy subsidies generally saw milder impact. Over the longer term, as oil's share of energy consumption falls, we can expect these price shocks to carry less weight. In fact, a cleaner, more renewable-driven energy system may bring lower energy costs and less price volatility, a deflationary force over time. That said, transitions bring their own frictions and price pressures. Managing that shift will remain a critical challenge. Now, let's turn to something that continues to be both a challenge and an opportunity: European banking consolidation. In recent years, bank valuations have remained low, partly due to a prolonged low interest rate environment and the need to bolster capital. Rather than issuing costly equity, many banks have turned to synthetic securitization, where KBRA have been active when needed to meet capital requirements. With stronger capital bases and cleaner balance sheets, some management teams are seeing this as the moment for consolidation. UniCredit's proposed takeover of Commerzbank was one of the most ambitious cross-border deals, but it ran into political resistance. Despite Europe's single market, national governments still prefer domestic ownership. Germany made it clear it wanted Commerzbank to remain independent. As a result, UniCredit has backed off, for now, but it still holds a stake that, once derivatives are converted, could amount to 30%. Another more recent notable cross-border deal is France's BPCE agreeing to acquire Novobank in Portugal. UniCredit continues to grow its presence with acquisitions like Banco BPM in its home market Italy, and even cross-border with a larger stake in Alpha Bank in Greece. There's also been domestic consolidation. Mediobanca and Montepaschi are in Italy, BBVA and Sabadell in Spain. None of these are new news, but the growing cross-border element marks a potential shift. If European banks are to compete with large US peers, they'll need to scale, but not just within their borders. So the real question is, will Novobanco's deal open the door to more, or is it a one-off? I would argue more should happen, but it will require governments to move beyond outdated ideas of financial sovereignty. Europe now has stronger safeguards in place since the global financial crisis. It's time to reflect that in policy and in action. We expect to see more political challenges from the industry ahead. Let's shift to the UK. Last week's spending review from Rachel Reeves was, as expected, relatively uneventful. The real action will come in the autumn budget, but for now, departments have been told to make real terms cuts and focus on fiscal discipline. The plan is to generate savings that can be redirected to growth-oriented capital projects, like the announced nuclear energy, housing, healthcare, infrastructure, defense, and transport spending. The hope is that this investment will pay off in the medium term, but with global tensions likely weighing on growth and new trade deals adding pressure to firms like Jaguar Land Rover and UK Steel, the government's growth strategy faces some real hurdles. Can they stimulate investment-led growth without more aggressive debt reduction? We'll know more in the autumn, but the stakes are high. On the investment front, there's been an encouraging signal for European growth. Blackstone CEO Steve Schwarzman recently stated at Blackstone's 25th anniversary in Europe that the firm plans to invest at least $500 billion in Europe over the next decade. That's roughly $50 billion a year, more than doubling their current $350 billion footprint in the region built up over the past 25 years. Apollo, too, has suggested a $100 billion commitment to Germany over the next 10 years. These are big votes of confidence in Europe's evolving economic trajectory and leadership's newfound focus on growth and potential policy adjustments. A strong conviction in the longer term for the region. As we round out this week, two central bank meetings are worth mentioning. The Bank of England and the Federal Reserve will both meet this week, and while the rising price of oil complicates matters, markets largely expect both banks to hold rates steady anyway. Still, the inflation and growth dynamics are shifting. So where does that leave us? Despite the relative market calm, the prospect for ongoing volatility does still remain elevated. Spreads are holding near last year's levels, and the recent Middle East tensions haven't really caused any major dislocation yet. We expect the data to become more mixed in the weeks ahead, and we'll need to look through the short-term volatility to assess the underlying resilience of the economy. As highlighted, European prospects still do appear to be appreciated by many in the markets, but broader global economic impacts are providing a number of bumps in the road. That's all for this edition of the Credit Compass. If you found this episode helpful, please like, subscribe, and share it with friends and colleagues. If you have a question or a topic you'd like us to cover, please do get in touch. We'd love to hear from you. And for more in-depth financial research and credit ratings, of course, please visit us at kbra.com. Until next time, stay curious, stay informed, stay resilient. Let the Credit Compass help guide your way.